After structuring the debt component and refinancing, we now have a newly built property. We have $60,000 worth of equity in the property, and the loan that we have with the property is being paid off by the rent. The renter's market is also a very saturated market, so we need to be very competitive when we're renting. In that area, the rent average is $2,200 per unit in a duplex. We're going to propose $1,900 per month for 2 units. Then taking away property taxes, insurance, and interest costs for the new loan that was brought into the property, we get to a total of around $20,000 in net income per year. Off of the $60,000 investment, that's a 33% return cash on cash, of which it's divided half from the builder and half to the investor. Even though that's a great cash on cash, that's not the beauty of this model. The beauty of this model is that we bet that in a period of 7 years, one of two things will happen. Either interest costs will go down, resulting in a higher cash on cash return, which results in a higher property value, or we're gonna see a great appreciation in 7 years. I estimate around 60%, which is a high number. This is my estimate, based off my belief that the US dollar continues to lose value year over year at an unprecedented rate. Upon exiting that business, either because interest rates went down or because we reached that appreciation in a 7-year period, getting that 33% cash on cash return every year and then exiting at the new value, we're looking at getting $60,000 and returning to our investor, to our capital partner, $320,000. That's a 5 to 6x multiple. The main understanding of this model is one, your construction loan should be at most whatever the refinance value that you can cash out from the property is once it's built. Two, rent at below market when you do your numbers. You want to rent quickly. The market is saturated. There's a surplus of supply. So you need to rent quickly. Number three, hold. Real estate is about holding. You need to hold for one of two things to happen. Interest rates going down, appreciation taking place. If you follow these three simple rules, if you look at these locations as perceived by the previous video, and you get into the construction cost, you can get $60,000 and convert it into north of $500,000 of net profit in a project.